be joined on stage by Bill Winters and Bernie Menzer, two real global leaders in the world of banking and finance. So we're going to have a conversation about some of the trends shaping and disrupting this industry, and we'll also get a take on ultimately what's happening in the region and the outlook for money and markets. So thank you again for being here. I think we can begin by just getting a quick take on some of the conversations that we've heard so far, because a lot of what we've been talking about today at the summit has been about technology and it's been about AI. So Bernie, I know this is something that you've been talking about. You said recently in the Financial Times that we could be about to enter what you called a super disruptor phase of global corporate life as we see these developments in AI continuing to scale. What did you mean by that?
Thank you. Thank you so much for having me, and it's great to be here today. And Bill, good to see you again. I think what I meant was we had just seen a huge amount of excess capital. I might call it excess, but definitely zero interest rate capital going into venture capital, into startups, because the world went through a long period where money was essentially free. And you saw that go into, not just into venture capital, but into private equity, et cetera. And so a lot of this spilled into a lot of very interesting ideas that were bubbling and coming through. And if those get pushed over in this period, I think that you could see a lot of those innovations come in and change the way we do things. I think my point a little bit was, with interest rates now at 5%, dollar interest rates anyway, let's just hope that some of that capital finds the best ones to get them across the line.
I think what we're seeing as well is companies that have a real technology strategy and a real AI strategy in place are being rewarded. And if you take a look at the performance, YTD of the Magnificent Seven over in the United States, then that is a case in point. So if you are a traditional bank with a traditional bank model, how are you adapting to these disruptive trends? Bill, do you want to speak to that?
I think it's, first of all, thanks as well for having me. It's a real pleasure to be here. Rain brings good luck, by the way. So I'm feeling extremely lucky today. The Magnificent Seven or whatever, those are companies that have obviously had exceptionally capable and strong technology, but they've also built very high defenses with their network model. And interestingly, we don't have a counterpart in finance for somebody who's established that kind of a network model. We had that briefly in China with Alibaba and Tencent. The government obviously came in and said, it's a little bit too powerful, a little bit too aggressive in terms of rent seeking. So we're going to bring in their authority, which they did. So Alibaba and Tencent is still extremely relevant and active in China, but part of an ecosystem. That's not the case, obviously, with the big US tech companies, where the ecosystem is becoming increasingly exclusive rather than inclusive. Why doesn't it happen in finance and banking? Because the big tech companies don't want to be regulated like a bank. It's quite oppressive, bank-style regulation. And that gives the banking community the opportunity to compete head-to-head with technology. So I'm sure the same with Bank of America. At Standard Chartered, we've invested massively in digitization technology. We own 13 different digital banks. We've got 2 of the fastest growing digital banks in the world. The technology is as good, or better, I would say, but objectively, it seems to be as good as anybody's technology. And why shouldn't it be? We're spending a lot of money, we can attract great talent, we actually understand banking, and we know how to navigate regulatory challenges and obstacles. So where you don't have this agglomerating network effect, which of course is what's benefiting the big US tech companies, then innovation can happen at full pace. And in finance, it is, and we're obviously part of that.
It's interesting because I speak with bank CEOs, of course yourself included. We've spoken a couple of times about this now. And the feedback that I get is that this is both a threat and an opportunity. Because when you look at the disruption that happens internally, particularly when it comes to banks plus AI, it's in customer service, it's in risk management, task automation, predictive analytics, even algorithmic trading. So at what point will we actually see a material return from either of your organizations with the implementation of some of these technologies? Are you doing it today? And if not, why not? Do you want to speak to that?
I can start off, yeah. So we absolutely are using it today. The technology infrastructure that underpins what we do at the scale that we both do it in and others is huge. And so in the US, we have 70 million retail customers. We have an application called Erica. You can speak to Erica in your car and tell it to pay a bill. You can ask it what your balances are. You can tell it ask it when you last had an electricity bill from this supplier. So that has been happening. We didn't call it AI. It was some form of advanced machine learning. Now we want to supplement that. We both have trading applications, businesses. Those businesses render, I don't know, probably, I don't want to guess for Standard Chartered, but somewhere between 4 and 7 billion prices a day that institutions can interact with. And each of those prices has to be accurate, sometimes to 6 or 7 decimal places, right? If you send a tweet out, it doesn't matter if you got the spelling right or wrong or the grammar is wrong. It not only has it to be accurate to a millisecond, because people make or lose money on those prices that you render, we both have 30, 40, 50 regulators that are looking at each of those, making sure those prices are not disrupting the market, they're not causing flash crashes. We need to make sure that the traders that are interacting with them are behaving the right way. So the scale and technology, and the scale of the technology that underpins us is huge. So we're there. We're highly regulated. So the challenge, coming back to your question, is, for me, what keeps me up a little bit is how do we consume new technologies at pace, right? How do we consume fintechs, new ideas, AI, working with the cloud, when we at the same time have to be super safe with our client money, because the monies that we manage for our clients are super important to them, and to regulators and to market functioning and to all of those things. So we would both, from our seats, like to drive our organizations along, but we're also sensitive when they come and say, we have to be careful.
Yeah. Fintechs are definitely our friends. We've got partnerships with 300 fintechs. We've got equity investments in about 50 fintechs. They're critical for the provision of, they're innovators themselves. They plug into our innovators. We build great things together. I make the distinction between fintechs and big tech. Big tech, we also work with very closely. But big tech would be a threat because they've got supremely convenient platforms. And if they found their way to engaging directly in our markets, we would have a hard time competing given the convenience that they bring. But as we discussed, that's not where they're focused. But almost 90% of all the transactions that we process in Standard Chartered Bank are straight through, zero human contact, like zero, from beginning to end. In retail, it's about 70%, and wholesale, it's over 90%. And our aspiration is to get to 99% on both. There will always be a role for human beings. There will always be a role for certainly when it comes to advice, interactions. But those sorts of businesses don't actually involve a lot of transactions. They involve advice and then maybe at the end of a process, a transaction. But for the vast majority of things that we do in banking, we are digital companies with digital budgets that are as big as any fintech in the world, probably by 10.
It's absolutely fascinating. And I guess when you look at what's happening with technology, you also have to look at what's happening against the backdrop of the global economy at the same time as well. So let's focus a little bit on that. For the benefit of some of the capital allocators in the room, no shortage of global challenges this year, whether it's the macroeconomic picture, rates, inflation, election, 2 wars unfolding right now. What would you say is the outlook for the rest of the year, and are risks skewed to the downside? Bill?
If you're in the middle of one of these conflicts, it's horrific, right? Absolutely horrific. If you're not in the middle of the conflict, chances are your life is going on more or less as it did. If you can overcome higher commodity prices in some cases and some inflation, things like that. But that's most of the world isn't living in those horrific conflicts, and business is carrying on. We know that each of those situations, and including high inflation, which is leading to higher for longer interest rates, are tail risks for the economy. So I think most of us are sitting there quite prepared, with extremely strong capital and liquidity positions, because bad things could happen. And that's, if we needed a reminder, it was not even a year ago that we had 3 banks in the US go bust, plus a big bank in Switzerland. And these are tail risks, but they're happening. So we've got to find a way, and in fact we are finding a way to enjoy the broadly favorable business environment, to prepare for these tail risks, but never to forget the level of human suffering that's going on behind the scenes or right in front of our faces in many cases.
Indeed. Bernie, your view on the outlook and where the balance of risks lie?
Yeah, I think I agree with Bill. The overall environment is positive, and there are tail risks, so I would agree with that. There are incredibly intense disruptions that are going on around the world that we need to be sensitive to, and you know, the closer you are to those, the more traumatic it is, and each of those situations can spill over quite easily. I was actually in Kyiv 3-4 weeks ago, and I just firsthand what they're going through there. But within that, I think there's some tremendous opportunities, and that's because the world has been pivoting, coming through some geopolitics, coming through COVID, coming through a long period of zero interest rates, and also with the sustainability agenda. So I'll give you a couple, just from my recent travels. Last week I was in the East Coast of the US, and you have Korean firms investing tens of billions of dollars in the car sector and the battery sector. China, despite its slowdown, has one of the largest EV companies that's shifting the dynamic. And actually, at the end of last week, I was in Mexico City and Monterrey, and if you haven't heard, Mexico is now the largest trading partner to the US. And it was interesting to see at close up what kind of trading is going on. And so I would say overall, you know, anecdotally, I sort of feel interest rates are a little bit higher just because, for a little bit longer, just because you see some of the employment constraints around the world, actually. And it'll take a while for those to work through. But I think a lot of those are just coming because resources are shifting, you know, allocations are shifting. The old period of supply chains and just in time, which had carried on for a long period of sort of, you know, globalization, as it were. And I'm not saying we're not globalizing as much, it's just that things are shifting around a little bit. And in those shifts, I think there's opportunities depending on where you are.
Let's talk about the region as well. The IMF forecast is for 2.9% growth this year. Obviously opportunity in the region, but challenges as well. What are some of the trends you expect to see when it comes to capital allocation and capital flows in this part of the world? Bill?
Whenever I hear these IMF type figures, it doesn't resonate with what I see on the ground, which is just tremendous growth. Obviously huge increases in population, but also huge increases in economic activity. That may just be the sorts of things that we're seeing from day to day. But this is an extremely bullish environment. Despite the fact that there's a war in the neighborhood, the Gulf is a sanctuary. It's a sanctuary for global capital, a sanctuary for people, and that was very clear during COVID, given the influx of business and people and coming with it. So we're extremely positive on the region. We see an interconnection, and I think this is particular to Dubai, but it obviously extends across the Gulf, but a connection as a trading hub and a money hub for everything east-west, a lot of things north-south, with obviously a meaningful component of trade going through the US and Europe or the Americas as well. So this connector role for Dubai at a time, and for the UAE, at a time when trade flows are changing so fundamentally, where Asia to South Asia and Middle East trade, obviously including China, becomes so critically important, Dubai is phenomenally well positioned. And that's the reason, from our perspective, that the UAE is now one of our top 3 markets, along with Hong Kong and Singapore, as big global connector hubs for financial markets, but also obviously for logistics.
Bernie?
You know, the thing that I've always been impressed with Dubai is that it hasn't relied on a huge wealth of natural resources. Dubai, and I'm not the world's best historian, I know I'm sitting in a room with people who know the region much better than I do, but it's always attracted you know, terrific human capital to leverage on the strengths that it has. And I think across the UAE, Abu Dhabi, Dubai, and all the rest, what has been really impressive perhaps since post-COVID is you've seen a crowding in of more of this talent. And in the world that we're in finance, we always say in our industry, it's all about the people, it's the ideas that matter. You can find the capital, you can find the resources. It's your human capital and your ideas and the mix of those, and people coming together to find solutions at pace, at scale. And it really feels that the region has taken a step up, partly because it's grown a little bit, partly because it's crowded in more people from more places around the world. So your ability to come here and find solutions for your idea, your capital, your venture fund, your new startup, your growth capital, your whatever it is that bit more able. And I think at the end of the day, that's what will endure for the region. And it feels and looks really good with that.
Okay, and before I let you go, I think we also have to talk about some of the flashpoints in the sector and some of the things that we're hearing about on CNBC about the outlook for the year ahead. One of the primary concerns is the fact that we see interest rate pressure easing on the banks this year. That's a good thing. However, there is $2.2 trillion in US commercial property loans coming due by 2027. And I want your take, is there a commercial real estate crunch coming, and what will that ultimately mean for the sector? Do you want to speak to that first, Bernie?
Yeah, so my background is in trading, and sometimes I think that when it's so well telegraphed, then the world is able to adjust. So there's been a lot of focus on commercial. There's different aspects to that, AAA real estate or not, hotels, malls, the whole gamut. The U.S. real estate sector is actually pretty sophisticated. It's had its booms and its busts. I expect that some of those assets will need recapitalization, or they may need restructuring. But the market is pretty efficient on that. Our exposure in that space is minor. There was a sense that you had these regional banks where 70-80% of their balance sheets were in commercial real estate in whatever city or state that they were in. But interestingly, you're seeing a lot of new money come in opportunistically to lend at the mezzanine level at great LTVs, loan to values, where the real estate has been repriced, and there's some terrific opportunities there as well. So I think the market will have some strain, but remain relatively efficient with some good opportunities.
Maybe some small spot fires among the smaller lenders, regional banks.
Yeah, like we saw, but manageable. We all managed through that. But I don't see anything systemic, famous last words, in that sector. There could be a confluence of things that sort of starts a fire, but I don't see that.
Yeah, and I think that's the key point. And obviously, interest rates go up, property prices, all else equal, will go down. That's almost mechanical. But if you look through the decades, obviously there's been a property cycle that's kind of a leveraged version of the credit cycle. And when the banking system is relatively weak, that accelerates the cycles a lot. And when the banking system is relatively strong, and by the way, it's very strong right now, which is not to say there aren't some weak players. And whether it was Silicon Valley Bank or Credit Suisse, obviously two very different situations, they were weak and idiosyncratically weak. The banking sector as a whole is extremely strong, measured by capital, measured by returns, liquidity. And so there is definitely going to be, and there is, a commercial property cycle, but it's not infecting the financial system. And as a result, it's not being accelerated in a way that generates real financial distress and disruption, and usually recessions. So there will be problems. The prices have gone down in the U.S., and they may go down further. But it's very manageable from the perspective of the system.
That could perhaps be one issue to watch. The other issue that I think global investors are watching right now is China. We are seeing quite significant stock market gyrations. There's a disinflation problem happening there, and of course, an ongoing property crisis. Bill, what's your take? Is Beijing doing enough to contain and stem some of the downside risks we see in that major economy?
China's biggest problem to me is a lack of confidence. External investors lack confidence in China, and domestic savers lack confidence. But I think China's going through a major transition from old economy to new economy. If you visit the new economy, which many of you have, I have, it's booming. Absolutely booming, well into double-digit growth rates in everything EV related, the whole supply chain, everything sustainable finance and sustainability related, et cetera. And they're trying to manage this transition without disrupting the financial system, which in the West we've never managed to do. Every big industrial transition has had a major depression that's associated with it, or a global financial crisis. They're trying to avoid that, which means it gets dragged out. I think they'll get through the back end just fine.
Interesting. Gentlemen, unfortunately, we are out of time, so we'll have to leave it there. But thank you so much for joining me today. Ladies and gentlemen, again, please make them feel welcome. Bill Winters and Bernard Mensah. Gents, thanks again.
Thanks, Bill.